As I said, thank you very much for popping in. Welcome one and all. Thank you very much for the heads up on the AV, Wayne. Cheers, Roger. G'day, Joe. Yeah, it's one of those unexpected things that catches everybody unawares. But everything emergency over, all is good. Right, okay, let's get into this without any further ado. Put up this important message just to remind you that this is for educational purposes only. Please make sure you do your own due diligence on anything that you see here. Make sure that you follow trading plans. Make sure you manage risk on every trading action. For those of you who are new here, what we usually do on an inner circle session is have a quick look around markets, see what we can see, and of course, if there's any chance that setting up, we'll chat about those as well. And then we get into the educational component, of course. Might cut the first part of that a little shorter than usual, just simply because of what's going on. But essentially, a few things going on, obviously. We'll talk about these and then we'll check out some charts. Obviously, we've got a market that's really buoyant. Record high for record high for record high kept being hit on the US equities. And that's despite a couple of headwinds. There's no sign of any movement on the shutdown. There's even some people suggesting it's actually deliberately being kept closed because it means that executive orders can be signed and actioned without any opposition, but arguably there's a lot of things don't go through Senate or the House anyway. The debate is still over healthcare now as we approach the month. Markets may start to get twitchy. There's a couple of things keeping markets buoyant, and the major one of these is earnings. We're in the second week of earnings season and we're smashing out of the ballpark. Over 80% are beating both EPS or surprising EPS expectations, and I think about 83% was the last number I saw, and then 80% have beaten revenue. It's really quite staggering how good earnings are, and that is what's keeping markets high, despite the shutdown, despite earnings, despite sticky inflation. But we do have a US rate decision tonight. The expectation, everything that's priced in suggests that the Fed will cut rates by another 0.25%. Some was even suggesting a half, not likely to happen. But that's despite sticky inflation and concerns about, obviously, the economic situation. Though one of the impacts of the shutdown is obviously that we're not getting much of the data out, not of the jobs data. Maybe it's relief by some in the administration that data isn't coming out. CPI is back up to 3%, but it was expected to be 3.1% on its last print, and it didn't quite get there. So even though it was higher, it was not as bad as expected. On the trade side of things, that caused the market a major wobble when Trump rolled out a bad post, a Truth Social post a couple of weeks ago, suggesting that tariffs in China were going through the roof because of their rare earth stance. We talked about this last week on the session. Trump is obviously in Asia at the moment, and him and President Xi are due to meet tomorrow, right here, which the market actually really responded well to in the early part of the week. So, and then of course, in terms of commodities, let's just have a look around at some charts. Gold has seemed to have come off the highs a little bit. There's where the Nasdaq is, just FYI. You can see that the chart just is staggering. There's that gap up we had on the back of that Trump Xi news that came out on Sunday, I think, and we had that gap up on Monday. If we look at commodities, gold pulled back fairly significantly through 4,000. It kept on dropping the last couple of days. So the early part of last week, early part of this week was the RC and the buyers coming back in today. And one wonders, that's a very sharp bounce. And if we look at where it is right now, it's around about back over 4,000. That's significant. And you can see on the shorter time frame, it's been a positive day in Asia. I'm probably watching this sort of 40.56 level for potential movement to 41. Why is it moving up? I think just an oversell. You see in the US dollar hasn't done anything, so it's not as a result of that. Maybe we're having less central bank buying. Um, Maybe the fact that Trump and Xi are talking is helping. Um, and there was a lot of buying of gold, which was sort of sentiment, also trying to safety, and a general international central bank concerns about the state of the US. If we look at copper, copper is looking interesting. Um, we are pushing against a key level there at 522. You can see the significance of this level here at 512, which we breached on Monday. Since then, we're pushed up to this next key level at 522. We breached that, and the buys will certainly pile in. This is a really important price point for copper. You can see that we did test it all the way back here in June. There was an intraday test here as well in early October. So the fact that we're testing that again, this would be a high close since that pre-US tariff on copper drop that we saw before the 1st of August, 50% tariff of US imports of copper. So at the highest point since then, we've retraced around about 2/3 of that drop. So quite a spectacular move up in copper, and I'm liking this quite a lot. So this is my commodity chart of the day is copper. As I said already, the indices are looking rather interesting. You can see strength in the euro today on the. Let's just have a quick check in on the scanner. So you can see the euro is doing really well against most currencies, euro yen particularly. So if we look at the euro yen on a 30-minute chart, you can see we've got like a sort of push up to this level here of interest around about this sort of 177.30 possible move up, reach that level to retest this 177.50. So around about a 20 pip move to the upside. The Aussie yen is also looking interesting. We've had a little bit of a pullback after what's been a very, very interesting day on the Aussie. If we look at the daily chart, you can see why this level is proving sticky. There is a previous high not hit since back here in July last year. So this is a really important price point here that we're challenging right now. So if we go to let's go to the hourly chart. You can see there that was tested intraday. Not surprisingly, it's got sort of sticky. We've got a 5-wick move or 5-wick test of that. But there doesn't appear to be a lot of selling, but it's a really key chart. I'm going to make that my FX chart of the day, the Aussie yen. Maybe the 30-minute chart is worth a slightly closer look. So we're on the 30-minute chart. I'll probably just push it up very slightly, but it does look as though it's got sort of stuck there. And we may be waiting for more info to come out. We just quickly check Forex Factory. And so you can see the Aussie CPI was hot today, very hot today. That's one of the reasons the Aussie dollar is looking so strong. Obviously, we've got the crude oil inventories as well before the federal funds rate, as I said, expecting a 0.25% drop. Watch for tomorrow, actually. We've got the BOJ. There is a general feeling that they won't shift, but the press conference will be interesting. It's thought they may be telegraphing some things, but that's a really staggering CPI. One wonders whether that might scupper the chances of an RBA rate cut when it next meets, which was looking in the balance if we just look at the rate tracker. But that, of course, is previous data, which will be updated tomorrow. But let's just have a quick look at that. See what the chances are. So meet on the 4th of November. You can see it has actually updated after. So yesterday it was about 2/3 to or about 60-40, a chance of a pause, which is diminished during the course of the month. You can see there, if we look back a couple of weeks, it was almost a dead cert that there would be a drop. That CPI data is going to play into that narrative, and my guess is that they will pause now, unfortunately. So sorry to not be the bearer of good news with this. Okay, so yeah, and just one other. I'm just going to reference it today. Let me just pop it on. Share CFD. I just wanted to give you one ASX and one. Let's just have a look at NVIDIA pre-market. Let's stay where we are. If we look at NVIDIA, there's NVIDIA smashed through. Of course, US earnings season, absolutely smashing it at the moment. And we're above that 200 key 200 level. Looks as though, well, after essentially the best part of 3 months, stuck in this range between about 170 and 190. We've breached that, and we've just seen the buyers flying. Yeah, I can surely have a look at Tesla. MU was a chart we were looking at, and that's obviously doing really well. Also, AMD. Again, this is a chart of the day, I think on Monday. When we met in our live update, that's going really well. Still looking very tasty indeed. But and then Tesla, which is going to be my US chart of the day, has now moved above these closes here. It looks as though it's heading towards a retest of possibly that 480 in the short term. So around about 5 or 6% up to that, and then of course we are in record territory. 489, I think, is the level to watch. You can see that was hit back here last December. So there you go. Okay, so let's get into the educational content of the day. And I wanted to talk just in a little more detail about the concept of multi-timeframe analysis. Obviously, when we look at trading, it is a game of context that price is almost irrelevant per se. So to say that X asset is at X price is completely meaningless without the context around that. And of course, if we take that to the next degree or the next level of thinking, is that context is not only supplied by what's happening around a particular time, but also what's happened previously, because previous price action breeds price action and what is happening to sentiment overall. So accepting that context is the thing, then a setup invariably works when the market when the market environment supports it. And the best way of it supporting it, of course, is that you get multi-timeframe agreement. I've talked about this quite a lot. I mean, if we look, for example, at the Aussie yen, if we look at the daily chart, why this price point is really quite important, as we've already talked about. Look at the daily chart, you can see that this is important because it was important last level. We've got an uptrend is the context. If we look at the hourly chart, then you can see again, we haven't seen this for quite some time, this level here. There's a trend continuation following a breach of a price high yesterday, suggested it was going to go up to there. And then, of course, if we knock on a shorter time frame again, you can see once again that becomes important. We might say that even more so. We are in a range right now on the 15-minute chart, as you can see by this range tool. So now, if it reaches this 167 level, and they've got multi-time frame agreement, whichever way you slice it, that looks important. Whereas if we just looked at this in terms of the 15-minute chart, what we'd see is we'd sort of say, well, hey, look, that's all well and good. We've had a good move up today. Now we've got a price point that looks as though it might actually turn bearish. But if we went short on this and just looking at the 15-minute chart, there's a fair chance we could even get caught on this. So let's say we thought a short might be here. Yes, it might pull back here, but of course that isn't supported by any of the other timeframes, and so has less chance of doing well. I mean, you can see that in any uptrend. The nature of an uptrend is higher lows and higher highs. Downtrend the reverse, of course. And so we've had that over this period of time, and even more so here after that fairly big retracement. There's the low, there's the higher low. This might create a higher low again, suggest possibly here, and then we get the breach. So context is all important. And so what there was a trader I know now, or I've known for years now, Nigel Hawkes. He would always utilize 3 timeframes because he suggested that single timeframe was tunnel vision. If you focus the potential storm around a potential price point, you may miss out on both points and may end up going against the trend, which is usually successful. Most traders think they do some sort of multi-timeframe analysis, but really simply glancing another chart isn't enough. So you've got to look a little more in a little more detail of that. But what happens is we're often so keen to get into a trade where you don't invest those extra few seconds that we need to. Of course, it's one of the reasons that we looked to let's put back buy Bitcoin. So an example here, we might get very excited and think about, well, we might have got very excited at this move to the upside, but you can see that failed. Why did it fail? Because we've got a move which isn't supported by the other timeframes. I just want to quickly, one of the reasons we did this, find it. So this is our trader dashboard, and of course, one of the reasons we did. No, it's a trading panel I want. On our traders panel, which we developed for MT5, just see if one's open. No, that's a gap. Okay, what we'll do with this is I'll just show you. So we can actually develop tools and stuff that actually do this for us. So if we just do that for a second, just do that. All will become clear in a moment. Okay. So this is just a sort of example of a tool, sort of tool that you can develop. So this is a traders. This is a trading, if you like, a trading panel. We can see if we look at the US Canadian dollar. We've developed a tool here which allows us to see at a glance what the confluence is across multi-timeframes. So in this case, we're looking at an hourly chart, and we can see that the 4-hourly and the daily are both looking short. So we wouldn't be that keen to jump into a long trade at the moment because there's not the support from the other timeframes. So we can develop all sorts of tools that do this for you, just make life a bit easier. But the reality is that if we have, the logic is this, quite simply. We've got traders who like to trade the shorter time frame, so 15-minute chart, 30-minute chart, for example. We've got traders who like to pop in and out of the market several times a day. People like trading the hourly chart, maybe the 4-hour, and then we've got those who like a longer term approach, so perhaps we'll do the daily. Then we've got our scalpers who may be sort of around about 5 minutes. If we've got multi-time frame agreement, then essentially you've got all of those four groups are waiting for a potential breach of a specific price point. Then if it does breach that, we're going to get a much stronger move. It's really that simple logically. From a psychological point of view, of course, I want you to hesitate if there's conflicting signals, because essentially conflicting signals saying, well, which story do I trade? And if you decide not to give it some significant thought or talk yourself into a trade, even though there may not be multi-time frame confluence, then invariably you get late entries, early exits, missed moves, all of that sort of stuff. So clarity of what you're doing, and this is really why I'm doing this session, is to encourage you to actually systemize this look you have, accepting that most traders think, well, what's the higher time frame doing? It needs to be slightly more than that. It needs to be articulated in your plan or articulated within your EA code. So if you have that, it filters noise, it improves timing and aims to help trading with the tide, not against it. That's really the bottom line in terms of why some degree of multi-time frame analysis, irrespective of how you choose to do it, actually matters. So, as I said, some would suggest a 2-time frame approach, others a 3-time frame approach. So I've chosen the latter. And essentially the idea of 3 is you have 3 things you're looking at for. So a higher time frame will give you the overall trend and bias. The middle time frame will be the structure. By that I mean things like sort of key levels, and then the lower time frame is the entry trigger. What we're trying to do is remove the clutter by sticking to no more than 3. As I said, some would prefer 2. 3 makes sense because you've got those 3 reasons there. If you have too many things on your chart, really the 2 things, or the 3 things really are price, action, volume, and context, okay, or market structure. So anything outside of that is just confluence. Too many time frames, too much stuff. Remove the clutter stuff off your charts. If you're looking at too many time frames, there's more chance of conflicting stories. So don't go any more than 3. But you've obviously got to match what you're doing and which time frames you look at according to your particular style of trading. So if you're a scalper, you may use the hourly for a trend and bias, a 15-minute for structure, and a 5-minute for the actual exact entry. Some traders would obviously be longer time frames. So, for example, daily, 4 hourly, hourly. But you find your own groove depending on your particular style. Just an alignment example. So if we're trading the US, Euro US, look for a 4-hour trend hourly structure and a 15-minute entry signal. That Aussie yen would have actually been that Aussie yen would have been a really good example of that. So what we're doing in more detail, if we look at the higher time frame, we're identifying the dominant trend, the key longer term support resistance zones, and an overall assessment of market regime, trending or ranging, and possibly split those again into volatility. So you may have uptrend with increased volatility, uptrend with lower volatility, and vice versa. Middle time frame, we're finding the structural breaks, we're finding the pullback completions, so those key levels, those liquidity zones, any consolidation patterns that may exist, and then those your primary time frame is your primary candle and volume analysis. So what's your current candle doing? What's volume currently doing? And sort of confluence indicators around this particularly. That's what we're looking at if we split the story into those 3 parts in a little more detail. So if we look at common mistakes people make, there is arguably with increased risk, obviously strategies which are counter trend, things like mean reversion, is obviously a case in point. But if you are trading against the higher time frame bias, make sure that your potential reward is clear. When you trade the idea, it may not. You need to be really sharp in terms of when you know your trading idea is working. Try not to mix signals from different timeframes. It rarely works unless they're matched to purpose of the underlying strategy you're trying to take. So don't just slam more indicators on hope to find one that confirms your particular idea. And often simple is good. This idea that more thinking equals better trading is not necessarily the case. There is certainly a point. Let me just give you a simple example. If you've got 16 reasons to enter 16 ticks you need to enter a trade, or 4 ticks to enter a trade, then obviously 4 ticks is more likely to happen because it's clear about what you do and when. The more complex you make your trading plan, the more difficult it is to follow in the heat of the market action, and the more likely in that process that you're going to miss opportunities. So it's this balance of having enough. So putting more and more indicators in on a chart, even though it looks very pretty and would possibly sort of look nice in a frame in the Louvre if it wasn't been robbed, then it is not necessarily going to serve you well from a trading point of view. So obviously one of the common mistakes that we often see with traders is they'll put multiple indicators on a chart which will tell them exactly the same thing. So simple is good. You need the detail to create high probability entries. There's nothing wrong with having some confluence factors, but make sure that they are restricted to the one that tell you something different about the market without making it too complex. Just be careful also when we talk about compression, trading compression. We're often talking about market price being compressed into a range, and that may be a tighter and tighter range over the course of time. We see this with things like tightening Bollinger Bands. But just be careful if you see sideways trending. So you might have a system which says, well, look, as long as I'm not in a downtrend on my longest time frame, then I'm okay with it. But if that longer time frame is stuck in a relatively tight range, it may look quite tasty on the other 2 time frames. But just be aware that is possibly a riskier situation, or as high a risk of a sudden move, because the more compressed price action gets, often this precedes like sort of really big moves. We often see this pre-data just as a result of the data coming out, but at any time that can be the stage. So don't think it's okay that something is in sideways trend on your longer time frame, unless the range is getting slightly wider or is wide enough to start with anyway. But if there's a decreasing gap between the top and bottom of the range on a tighter time frame, on a longer time frame, that's often not a good place to be. Even though it might look in a sideways move. I hope that sort of made sense. Let's just see if we can find an example of that, maybe. That'd be a good thing to do. And let's do it without the indicator on. Okay, let's look at the daily chart. Let's stick some Bollinger Bands on this. So what's the quick way to do this? Let's do it on 4 hour. Let's get a bit of clarity. Okay, so So this is possibly a good example here. Let me just put a, just so we can find it. So you can see if we're trading 4 hourly, hourly, 15 minutes, something like that, you can see here we've got a compression of price within an ever decreasing range around this point here. Okay, so if we take that to the smaller, but it is in a general downtrend, but it is getting tighter and tighter, and there is a base on that as well. Let's say, yeah, so let's say somewhere on there. Let's see if this works as an example. Okay, we need to find, okay. So we might look here and say, oh, well, look, this is in downtrend now. It's breached that level there. Let me just bring that closer so you can see. It's breached this level here. This is looking good. And then we go to the 15-minute chart. So we've convinced that we've talked to ourselves. We've said, oh, yeah, well, look, it's sort of in downtrend. It's sort of in downtrend on this. If we look at the hourly chart, let's actually look around this area here. It's still in downtrend, but it's in compression on the longer time frame. And then, of course, if we can find it, sorry, I should have done this better. There it is. So you can see the resulting action on this. So imagine we don't see, sort of how we'd see it would be like this. On the smaller time frame, we'd think, oh, yeah, that looks great. So we might get into this, possibly, we sort of might use this marker here. So we might use that marker there, we might get in, sorry, to move up a slight smidge. But because we've got this decrease in this compression of price, what happens the next move up? Let's say we sort of get in somewhere around here. As I've said, oh yeah, let's go short this. We ignore what's going on here. We ignore what's going on in the longer time frames, and ultimately we get absolutely smashed on this move to the upside here. So that's what I mean. Not the best example on the planet. I hope it sort of gives you the idea of what we're trying to talk about in terms of avoiding this state of a ever compressing range, even though the trend looks as though it's to the downside. The range is getting smaller and smaller, and then boom, we get that move to the upside. In fact, same here potentially. You see, you get a compression of price. It's not the best example. It's really just a pause and a move up. But if we'd have entered here, then that would have been a recipe for getting melted. No worries. Okay, all good. Right, so just wanted to check that we're doing okay on YouTube. Give me a second. Yeah, we should be good. There we go. We're good. Wow, we're in. I always see it really delayed. Okay, so in terms of practical implementation, really the bottom line is it should be part of your trading system. So it's no good just having in your trading system written, I'm going to have multi-time frame agreement. You've got to have additional detail on top of that. So you're looking for trend, structure, entry trigger, and clearing risks. And exactly which time frames you're going to look at. And then remember, it's not across the board. It might be depending on strategy or depending on what your primary frame time frame is. So it might be if your primary time frame you're going to be trading is your 15-minute, you may choose a 30-minute and an hourly. If it was 15 to 5 minutes, if it was a hourly chart, you might go hourly, 4 hourly, daily. So you need to pick the time frames that are appropriate to not only your trading style but also your primary time frame. There's all sorts of discussions. I remember we have a look at this at another stage. It's not necessarily just for entries. Remember, if you enter on a lower time frame, what you're doing, if you're adopting this approach, is you're using the other time frames for confluence or conviction of your potential trade idea. If that changes, if your higher time frame flips, your bias must flip too. So even though it's maybe not completely showing as an exit on a shorter time frame, if you're, let's say that example of a higher time frame has started to go into a tighter range, then perhaps it's a signal that you should get out. But remember, this isn't a standalone. It's not a new system, but it's got to be part of your existing one. If you believe, as one of your fundamental trading beliefs, that trading with the trend is good, that multi-timeframe analysis is good, it's all very well giving lip service to that, but the practical implication of that, or the practical implementation of that, is to actually stick something in your trading plan. So do that. It's not hard to do, but it's a really important point to do it. So you, in the heat of the action, you know exactly what you're looking at and when. Obviously, once you've done that and start to record variations on that, so you adopt the what would have happened if approach to this. So you would trade one time, and you can gather the evidence to say, right, if I'd ignored what else is going on, what would have happened? If my primary time frames, I'm using a 5, 15, and an hourly, is that okay? Does that give me a better information than a 5, 30-minute 4 hourly, for example? One of the reasons why we make market regimes optimizable in our EAs is that it does appear that for different asset classes, then we've got different variations in terms of which is the ideal time frame to look at that overall trend. A couple of other things which are probably at a sort of next level that are maybe worth having a look at, and I'm just planting these for ideas if you're already at that level where you've got this articulated within your plan. Volume across timeframes is sort of interesting. Theoretically, higher volume from above does give extra conviction to them to suggest a momentum in that move on the longer time frame, as well as what we all often talk about volume on the shorter time frame. But if we have increased volume on the longer one as well, it does add to the weight of evidence. Another tactic people often use is that rather than looking at 3 different charts, what they'll do is they'll put on a single chart multiple moving averages. So they may have a 10, a 25, and a 50. So logically, I guess, if you're on an hourly chart, a 50 EMA, sorry, a 40 EMA, is sort of looking perhaps at on a 4-hour chart on a 10 EMA. It's not exactly aligned, of course, but it is another way of looking at this. But if you're deciding to go down that route, test out your theory. So actually test, does a 10, let's say you do a 10, 20, 40. So your 10 and your 20 are your 2 shorter term MAs, your 40 is what you're using for a long-term trend. Does that correlate to a movement on a 4-hourly chart or a 2-hourly chart if you're trading a half hour? And yes, you can do 2-hourly charts of MT5. So test that out. Don't make that assumption that longer MAs are a replacement for whatever you use to measure trend from a price action point of view. Don't make that assumption, but test it out for yourself. Session awareness is obviously important as well. Obviously, we get the most significant moves at the start of the European, and then again around the US market open, whereas Asia tends to be flatter, lots of mean reversion. So I do reference this in a previous session. that perhaps your confluent sort of argument about the longer time frame is within the context of which session are we trading in right now, or if you get close to the start of a new session, or for example, let's say that it was the US CPI out tonight in is a couple of hours or so, if it was tonight. Maybe it's worthwhile. You've got to take into account those other factors as well, and the fact that you often get session changes per session as well. Now, there's a couple of other things which the middle time frame just seems a bit, oh yeah, whatever. I'll just come along for the ride sometimes. But the middle time frame can be sort of useful. If we are looking at structure majorly on the middle time frame, maybe that is the time frame to set things like profit targets. So look for structure like support resistance lines, previous swing highs, swing lows on your middle time frame. Might be worthwhile checking in on rather than the noisy primary time frame, particularly if you're trading short ones like a 5-minute chart. Maybe looking at if you were doing 5, 15, and hourly as your 3 time frames, maybe the 15-minute chart is the one that you set profit target stops on, based on the market structure on that middle time frame. So again, have a look at that and see if that works for you. Again, do a what if analysis on some of the trades that you've taken, either to suggest that perhaps you could have done better because you've let a noisy couple of bars on your 5-minute time frame previously sort of dictate where you stick a profit target, compared to you that would just be shown as just part of a wick on a middle time frame. So have a look at that as well, if you're already in the place where you're already using multi-time frames. If you're not, then your first stage is obviously what we talked about before in terms of articulating this within your system and how you actually, which time frames you're going to have a look at for what set of circumstances, and then move on to these others, such as the multi NAs on the same time on the same price chart, and then looking at the middle time frame for possible stop and profit levels to avoid some of the noise. And if you think that there's some merit in developing some whiz-bang multi-time frame beyond that panel that you showed me, that I showed you before, drop me a line with your ideas. What would you like to see? If you could see it on one chart, if you could see it on one screen, you've seen what we can do with one screen. I've shown you that already. That GB pound Aussie is looking really interesting. So on the daily chart, it's sucky, but there is potential evidence on this. So what we might say, this is the exception. So we're looking for a mean reversion type of approach on this. Or if we can't find it, what we might say is, right, we're trading the 15 or maybe the 5-minute on this, and trading the 5-minute as our primary time frame, which will be an entry perhaps above this level here. Do we have agreement on the 15-minute? Yes, we do. And the 30-minute? Yes, we do. So what we'll be doing is we're looking at the 15-minute, and we will be using this potential level here as our take profit, and this potential area here as a sort of stop beneath that. So you're looking at a sort of 1 to 1.5 ATR. So that would be a good example of how we might do that. But of course, if you put on, this would be my guess is that this would be a typical mean reversion at this stage. What we've got is we look inside the Bollinger Bands, and you can see that it's happened on the 15-minute, a long time ago on the 5-minute, and even has happened on the hourly chart. You can see it moved out. Now it's moved back into the Bollinger Bands as well. Nice mean reversion on that. So hope that was useful. can't remember what I was doing now. I know what I was doing. So, I mean, we could even have some, I mean, you can see what sort of panels we can create. We can even create a big one here that produces some whiz bang, or one that goes across the screen that is a whiz bang heat map type of thing that goes beyond what you saw before on that mini panel. We could extend that a little bit, I guess. Anyway, so thank you for being patient with today. I hope it still give you something useful and practical to walk away with. Just review the material today. And if you're new to this, or you haven't got any way of looking at anything beyond that, I think looking at multi-time frames is an idea, in inverted commas. If you think it's a good idea, then you need to systemize it, put it into your plan, measure with and without, obviously, over the next few trades. Decide how you're going to integrate it into your trading system with clarity and unambiguity. And of course, then there is the potential, for those of you doing that already, there's the potential advanced things to have a look at. And even if that's just testing assumptions that actually 3 moving averages on a primary chart is good, or it's good with errors, or it's good, or it's not good at all, then do investigations into things like that. Again, we can use all sorts of scripts and EAs and all sorts of stuff to test that out as a concept. Anyway, I hope that's useful, practically orientated, as well as giving the why. It's something that we reference regularly. Make sure that you've hung it on a system. Just looking through, thank you for the comments and the questions and the support throughout. I really appreciate that. Keep it simple, absolutely. The KISS principle in trading, completely agree. That's interesting, right? Interesting feedback. Gene says use 520/60 EMAs. That's a reasonable place to start, and obviously, it's not that hard to test that out. EA yesterday was short at New York Open, where the 3 EMAs crossed over. What time frame do institutional traders use? Good, 2 questions there. Joe, good question, mate. So institutional traders, or now institutional automated trading, using multiple time frames, you often have a matrix of, even if it's looking for longer time frames, usually have a matrix of so EAs will clock on at different times. So you'll have a 5-minute EA, 1-minute EA, 5-minute EA, 15-minute EA, all on the same asset. A lot of institutional traders, you've got your high frequency traders at one end, you've got your long-term holders at the other. So it's really, most institutional traders that trade stocks will trade sort of daily charts. Most FX stroke index traders will trade 5 or 15-minute, unless there's some automation, some algos there. Yeah, GB Pound Aussie was a really good short yesterday. I think we had a couple of EAs took advantage of that. Okay, Rodney, thanks very much. Cheers, Roger. Thanks, Michael. Joe, thank you very much. It's always really good to see you all here. Joe, it's good to see you. I hope things are well in your world, buddy. Thank you very much for your patience and your support, as always. Enjoy the rest of what's left of Wednesday. I love and leave you. You take care of yourselves. Trade safe. See you again very soon. Bye-bye for now. Oh, yes. And if you are watching on YouTube, thank you very much, Wayne. Don't forget to click on the like and subscribe. Just give us a little thumbs up. It always helps. It always helps the algorithm. And what it does is it means that when we are in a session that's streamed on YouTube, then it's more likely to pop up. If you click subscribe, you'll get live info. There are sessions running. Hi, Sonia. Thanks for saying hi on YouTube, by the way. Thank you very much. All right, you guys take care of yourselves. We'll see you again very soon.